FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome, and you are listening to the Financial Survival Network. I'm Kerry Lutz, March 27th, 2018. Hey, as always, join the discussion. Email us, kl@kerrylutz.com. Also, the hotline, 914-424-4142. Leave a message. We'll probably play it. Well, over-financialization, over-emphasis, obsession with finance has probably gotten us to the mess we're in now. Is there a way out, or is the way out simply a collapse where we all come to our collective senses? Danielle Park, as always, has a lot to say about the topic, and visit her site, jugglingdynamite.com. Hey, Danielle, happy Tuesday.
Hey, thanks, Kerry. Happy spring.
Yeah, spring has sprung, although up in the Northeast, they were rewarded for the change of season with a nice nor'easter, which was like their 4th one in the month, but hopefully that's over with. I was up there over the weekend, and most of the snow was gone, and it was pretty warm, 40s, 50s, very tolerable. But what's intolerable is the fact that this overemphasis, obsession with financialization, I mean, you've seen it distort the labor markets, where aerospace engineers start writing financial algorithms and go to work at hedge funds. Total, not just a misallocation of capital, where financial institutions were supposed to be a means to an end, not an end in themselves. But also you wind up with all this malinvestment in capital, in labor, and in time, in careers, all these things. It's just really had a profoundly negative effect that's been building over the past 2-3 decades, but really has come to a peak now.
Well, you would think it's come to a peak. It's hard to imagine how it can get much worse, although, I pause in saying that because it has gotten more worse or worser.
Worser, as my kids would say.
Spring for me is a very interesting reflection point. As I look back, and I vividly recall March of 2000, for example, the top of the tech bubble, in the cycle that was, driven after the bailout of long-term capital in 1998, and the doubling down on risk, and the sense of Wall Street being able to get away with whatever it did and no repercussions, and keeping spoils of crime and no one ever taking back profits or putting one behind bars. Then you had the big collapse, and of course, March 2009 was the low of the second cycle. So, the second bubble bursting in 07, 08, the low in March 09, and now we've got March 2018, and the 18 years since the top of the tech bubble, and we've got the tech stocks really back in bubble territory, and you've got the same players, only the financial sector's gotten richer in terms of the executives, the people who have filtered the funds out for their own personal wealth. They have made themselves billionaires. The Jamie Dimons, the Lloyd Blanc Fund, the America's Most Wanted, as I call them. They're on the business news television every morning. All the head honchos from all the different firms. They've all become incredibly more wealthy in the last 18 years. But the net worth, the balance sheets of everyone else have taken a hell of a beating. And I say that with knowing full well that right today, for example, U.S. household net worth, if you look at assets minus liabilities, people will argue, well, it's back at an all-time high, so how could you say that? But what they're missing entirely is that at the peak of bubble cycles, the assets are always so dramatically inflated that it does have a peak of net worth. And we saw that in 2000, and we saw that in 2007. And of course, it's not sustainable because the prices are incredibly overinflated. They start to burst, and when they do, the debt does not. The debt stays constant as asset values fall. And then you get this really negative rapid evaporation of what people had perceived as net worth. And they're left realizing that they have very low cash levels, very little liquidity, a bunch of assets that are largely illiquid or that everyone's trying to sell at the same time. And it's, no matter what, the banks will always want to sell more. That's their entire model. They have perfectly orchestrated it. Not only are they behind corporations which have all the rights and none of the liabilities in the current legal structure, but they have also divided this sense of obligation or duty to the customer's best interest. They've been able to parse that off from their product creation and selling mode. And because they are not held to any fiduciary standard for the recommendations they make, whether that be to governments, whether that be to companies, to pensions, to individuals, they're always out to make a sale. And that business model has really sucked the sap out of the economy, out of households everywhere, and we're left with nothing but IOUs. So really, to imagine that this could go on much longer, I think what it's going to take is an implosion of those asset values again. A deflationary period where housing retraces as well as security prices. And then you're going to realize that as that tide of superfluous valuations recedes, people are left with the mountain of debt, which is now larger than it's been at any of the cycle peaks in the past. And again, as long as that bubbling valuation is obfuscating that, people are not maybe as aware. But once rates increase, which we've seen, Carrie, the cash flow starts to crimp. And I think that is the tipping point where we've seen a surge in defaults already, for example. Write-offs are rising. These are all very late cycle hallmarks. And because we have the most debt we've ever had, they're likely to be much more pronounced this time than even in the past two downturns.
No doubt. We never learned the lessons. We've talked about this so many times, and yet it's falling upon deaf ears. So we obviously have to go to the bust for people to learn this. I mean, I remember my grandparents who'd lived through the Great Depression didn't trust banks. They really felt like they were, of their day, the things they were doing compared to now are so benign, but they felt they were basically in business to steal money. And now, in the age where they charge you to make a deposit, they charge you to write a check. If people still do that, I'm not sure. Most people don't write many checks anymore, but nickel and diming, they're all about the fees.
Truthfully, Carrie, those are the things they should be charging us for. See, here's my point with this model. We do need a reliable, trustworthy banking system to accept our deposits and to make transfers to one another through the economy. So I would fully support us paying for the traditional things that we always did pay for to make that franchise sustainable. So absolutely, transparent fees that we have to pay. But the thing is, it's not the nickel and diming part that's bankrupted the country and the households and everyone else. It's the hidden profits, the skimming, the fees on fees, the front running, the proceeds of crime, the money laundering, all the things that they've been doing to make themselves inflated profits, which are and underwriting securities. In many cases, the public is not even aware of the enormous commissions that are collected by those institutions for underwriting and floating securities that they sell through their distribution channel to mom and pop. So those are all hidden fees. That's where the money really is. So I'm all for let's get the fees up front. Let's pay a fair cost for the service, but let's get some disclosure and cut out all this cross-selling and hidden stuff.
Yeah. So cross-selling, I agree. But the fees also, what I'm really referring to more is you still get mortgages through banks in the States. And the bank has no interest really in whether or not you default as long as you make it through the first year. Because then in the first year, if you default, they have to pay money back to Fannie and Freddie. And all they're in business for is to collect fees and that, to be the intermediary. And it's the kind of thing that really it's just not helping the market. We can get into the whole federalization of the individual mortgage market in the U.S., but that isn't the point. They just exist to suck up fees from whatever source it may be. And sometimes that source will be maybe in the traditional areas of bank accounts and credit cards. Although, again, credit cards, another perfect example. There should be probably a 10th or 25% of the cards outstanding that actually are. But the 20% interest rate just is an irresistible lure to the banks. And rather than investing in promising companies that will employ people and presumably add some value to the economy, they focus on consumerism. And all the incentives are just totally out of whack. There's no sanity here. Somehow it's more laudable to go buy a huge 75-inch flat screen or 85-inch flat screen for $10,000 than it is to start a new business and try to borrow $100,000 from the bank. They'd much rather loan you the money for the flat screen. And either way, it seems like a loser, consumer finance in the long run. Just look at what it's done to General Electric. They were doing great when they made toaster ovens and washers and dryers and appliances and jet engines and diesel locomotives. When they got into consumer finance, that's kind of been the bane of their existence, why they are where they are today.
But it's also the off-balance sheet accounting stuff. So this is another chapter of financialization. We saw with Enron, who went from a very highly profitable energy company to a off-book financialized monstrosity that ultimately went bankrupt. That model, that great movie, what is it? The smartest guys in the room or something, that book and movie about the Enron collapse. But this is what happens with financialization gone wild, without any checks and balances, without any transparency, disclosure, integrity in the system. You just get, more of the same, blow up the balance sheet, Bain Capital, harvesting all the cash out of Toys R Us. It goes bust. Everyone's amazed, left with all the debt and all the cash is taken out. So this is the model. Now, there was a central banker this week in conversation whose name's escaped me at the moment, but he put forward a proposal, which I've been saying for at least a decade, which is maybe we should start tying executive compensation to balance sheet instead of the income statement. In other words, to the debt management of the company rather than to getting the share price up. And I think that is an incredibly important part of this puzzle is, we have to get people focused on not just how do we goose the appearance of wealth, how do we goose the sales at the expense of long-term stability, but how do we actually get people back to saving so that they can invest in things that the economy needs, like starting businesses, starting families, having that flexibility. They need to have savings to pay for our infrastructure. We need to have savings. But once we got to this model of, well, no one has savings, don't worry about it, we'll just get a line of credit, that's when the banks, the financial firms took over and extracted all the money, and everyone left with all the rubble.
Yeah, isn't that the truth? And so it also goes down to the obsession with the quarterly earnings report. Nobody cares about Apple 10 years down the road. Nobody seems to think about it, taking on all this debt for share buybacks, et cetera. Nobody cares about any of these companies past 90 days. Our time frame has become so micro-focused on such a short period of time. Look, what happens? Nothing major really happens in a 90-day cycle usually. Yeah, stuff happens, but it's not that it so much happened during that 90 days, but it was a buildup to it. Mm-hmm. And there was clear signs of what was going to happen. But because of Wall Street's hyper-focus on 90 days, it gets ignored. And that's a bad thing for society, for individual investors, for everybody.
And it translates down the pipe into portfolio performance reviews every 3 months.
Yeah,
So this is so investors think of the company as a as every 3 months, we better see progress or else. Not only we better see progress, we better see earnings growth, sequential earnings growth of a certain rate or else. Even when a pause or a pay down period is the most important thing for the health of the longer term enterprise, they want to see, a perpetually spiking growth in sales numbers and don't really want to measure it by anything else. So it goes back to how the company's being incented, how executives being managed, being measured, and how investors are looking at, what they're doing. So again, it rolls back down to portfolio management, where people are expecting portfolio managers to produce X percent per quarter without any variation. Well, it's an absolute farce. It's not, it's not investing. It's some kind of manic gambling where if you win and you keep winning, people think you're great. And then when you lose, they look for who they can sue because, they didn't want to have any variability on the downside whatsoever. They only wanted to have the impossibly stable, perpetually increasing gains on the upside. So, but the thing is, it really doesn't work. It works for periods of every cycle, and we've seen this repeatedly. It doesn't work over the long term. The Canadian stock market, just as another example of this, is at 15.2 today, which is the same level it was last in July of 2014, which is the same level it peaked at in June of 2008. The S&P has been this, your U.S. market has been the poster child for financialization and manipulation and front running and QE and all these things in the past few years, which have made it dramatically outpace many other indexes. And yet that just means that the mean reversion downside is that much more pronounced for U.S. stocks because the valuations make no connection to reality in terms of what can be sustained over time. So even there, with all the yesterday we saw Monday we saw the TSX or the S&P. Friday we saw it drop by over 400 points. Monday we saw it rally by over 600. This is the thrashings of a fire hose that's come off the wall. This is what a bear market starts like typically, where volatility spikes, where mania prevails on both sides, and where you get all this algorithmic buying. So when you see something surge 600 points in a day on some nonsensical headline like China and Trump are going to talk, I mean, it's like, okay, that's really going to fix everything, and it's just, we're in this realm of, we're through the looking glass, Carrie, and this has been very little to do with prudent financial management or investing or thinking for quite a long time. And as I say, people will ask after this implodes for the third time in 18 years, what were we thinking? What were we thinking? And of course, as I say, you weren't thinking, you were gambling. You were winning. You were keeping playing. You weren't taking any chips off because you hoped you could just keep going like that forever.
And
that's where, the customer, the client, the investor plays a leading role in their own demise.
Yeah, it's so true. And, you just can't, there's not any one size fits all. And the fact is that talking your book, you watched CNBC. It's like, how can anybody believe anything they see there? It's purely financial porn, I would call it. It's really... It's hopeless. It's hopeless.
Yeah. It's sponsored by the people trying to sell you the stuff. They have hired so-called experts espousing the message they want you to hear. They use, all sorts of personality and certain physical attributes to capture your attention. And then they go from there to places like the White House. Let's not forget, Larry Kudlow's gone in now to advise Mr. Trump. Mr. Trump himself is a TV star. I mean, I'm afraid no particular comment on those individuals, but what I'm talking about here is a preponderance of people who have shut down their intellect and really gone with whatever they think sounds good or what sounds easiest. And that really brings us to the whole, in the old days where we would save first and then spend second, we have really over the last 30 years come to spend first and worry about paying a larger amount off over time once you include the financing costs, and therefore never get the saving because you're constantly just paying the financing costs and the payments on the stuff you've already bought. So we really turned this entire equation equation upside down. And that's why we are so precarious now. That's why we are so intensely exposed to cyclical swings. They've been magnified, not muted. And we're going to see that again here. So, I'm not talking about the end of the world. I never am. But I am saying that we've already seen sufficient tightening this cycle. We've seen more rate tightening in terms of relative change this cycle than we've seen even in the 03-06 cycle, which ultimately triggered the Great Recession, right? And we've got more debt today than we had then by many trillions of dollars globally. And people will say, someone wrote me this morning and said, how can you say that? Because look at this chart of net worth, which is back to you're missing that the bubbling assets are inflating the net worth, and that the bubbling assets are the very things that deflate the net worth again when the cyclical lows start to come. Yeah. So, we just have to get away from this mentality of spend first, save later, and go back to saving first and spending less.
Yeah, sounds easy. It shouldn't be a problem.
It is actually.
It's so logical.
It is actually easy, but it requires a lot more thought, and personal control, and not succumbing to the mantra of marketing machines.
Yeah, it's totally logical and from an unemotional detached standpoint, very easy. But you can never underplay or downplay all those dopamines that you need. The dopamine neurotransmitter, which works on the reward system. I mean, you basically do something right, you get a pat on the back, and it's a reward, and it produces dopamine. And when you're in the middle of these bubbles and you're investing in your market, your portfolio is going up 25% a year, pretty much year in, year out, without any real mental effort on your part, the dopamine's flying. But then one day it all stops, and the only thing worse than feeling like you're missing out is when the dopamine totally ceases to be produced because there are no more rewards.
And also, what's the opposite of dopamine when things crash and people lose their homes and their businesses and realize that they have to work another 20 years because they don't have enough savings? What is the lack of dopamine called?
I think that's depression.
Well, unfortunately, that's the other side of this.
Yeah, so no dopamine, and you can kind of make the right decision because, whenever your emotions are kicking up, either positive or negative, if you realize that, then you know that it's a really bad time to make an important decision. You need to come down from the high so you can get rational about it, and then you might have a chance. Well, you'll definitely have a chance if you go check out jugglingdynamite.com. That's Danielle's blog. A lot of good things on there where we took this subject from. Be part of the show. Email us, kl@kerrylutz.com. You can leave a phone message on the hotline, 914-424-4142. We'll probably play it on another episode. Hey, Twitter feed @KerryLutz, Facebook page, Financial Survival Network. We might very well be eliminating that Facebook page, Danielle. It seems that Facebook has turned into nothing but a giant data mining operation, which isn't just for the government. You expect them to be doing it, but basically to the highest bidder, whomever that might be, or not even the highest.
The secret profit model again, you see? I canceled our Facebook feeds about a month or two ago because, again, the skimming secret profit model, taking advantage of your trust, is not a business model I want to support.
Especially when all that trust is misplaced and misbegotten because they've done nothing, zero, to acquire, to earn that trust. What have they done? They put a platform in place, and a lot of people go to it and think it's cool, and they waste hours upon hours on it, Danielle. And the really alarming thing is that half the people out there get their primary news from this distrusted source. At least when you tune in to CNN or Fox or whomever, you know what their agenda is. you know what they're about. But Facebook disguises it all and makes it think that you're somehow in control when you're really not. Very dangerous thing. Hey, you know what? Next time we're going to talk about the Facebookization of information and data in the U.S. and the world. Billions of people, something you need to be concerned about. That's why you listen to Financial Survival Network. That's why you need to go to jugglingdynamite.com. Danielle, we'll catch up with you in a couple weeks.
Thanks, Carrie.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.